please subscribe, like, and hit that notification bell. Thanks, guys. All right, guys. You got to look at the charts to remove fear, clickbaits, understand exactly what you're looking at. Essentially, charts are going to give you the tool, but more than charts, technical analysis will give you the tools. So whenever somebody presents you information in a fancy graph, you'll be able to look at it and you'll say, okay, hold on. I need to do some technical analysis on it. I need to get my momentum indicators. I need to understand where I am in these longer term cycles, because I just saw this recently on Twitter, like, oh, interest payments, they're going through the roof. It's game over, end of fiat. Look, that stuff's not going to help anybody. It's like people would have thought it was the end of fiat in the 70s, 60s, as interest payments were going through the roof. So right now I prepared this little expose to show you that, take a step back, it's never the end of the world. But what you can do is prepare yourself and choose the correct investment vehicles, the one that are more probable of outperforming, and play those to protect you against this fiat depreciation, guys. Okay, there's no miracle about it. There's no falling to those fear narratives. It's not going to help you. It's not. You're just going to make you're going to make rash decisions, and that's what we want to do with charts, to remove that fear, remove all that. So here it is. Look, that chart, bottom left to top right. This is the federal government quarterly close interest payments, and the last date is quarter of January 2023. Here it's on log scale. Look, it looks bonkers. A lot of people show you that, right? Oh, look, it's going parabolic. Well, look, it's a linear scale. If I zoom back, oh, look, it's going parabolic. And you think it's the end of the world here in 1990, right? You think it's the end of the world as that thing rockets upwards. I'll just show you. Look at that. You think it's going to the end of the world, but it's not. There's phases, and I'll show you that even while something's going up bonkers way, what's more critical is understanding the rates of change, because that's what the market prices in, the rates of change. And when something happens too fast of something, then there's a shift in capital flows from growth to value. So from tech stocks to commodities to oil, gold, etc. And you want to spot those changes. So while this has gone bonkers here on the linear scale, put on the log to remove any type of noise, and then you see that it's not the end of the world type of ascent. So let's move on. Let's get some more data here, okay? The first thing I notice whenever I look at a chart, well, let's analyze. Let's look at the rate of change of this thing first. So here I will show you. I'll minimize this one. I'll show you the rate of change. I could actually do that here. I'll show you the 4-year rate of change for the federal government interest payments. What does that mean, the rate of change? The rate of change is at any given point, let's say it's at four years, how much percentage-wise, it's this scale here, how much percentage-wise did the price appreciate 4 years previous? So if I would, from here to here, 4 years, let's put my measuring tool just to show you. 4 years is 48 months, 38, 48, just about here. So this means that if the rate of change today is, for the 4 year, 126%, that means the price, if you would have bought here in 2011, the rate of change of federal interest payments went up 126% for that range. That's what it's telling you. Market prices that in. So what you do, you could do TA on this. Regular TA, 3 dotted line here. Pull, flag, breakout, reverse symmetry moves. Where's my next resistance? You could draw that in to see how far it's going to go before it stretches. Where could this peak? Here's maybe here, some type of neckline here. Resistance, support, breaks down. So that could be a resistance point. Maybe here's a little hump. Let me put that line. I'm going to call that a wall resistance. There might be another one here. Oh, look, we're surpassing it right now. So that's how you do it. Then You could add another rate of change. Oh, let's say the 7-year. So each of these, when they're synced and they're moving up together, it's beautiful, powerful. Then both rates of change are going down together, coiling. Then one of them starts moving. The shorter term one moves up faster, but after that, the longer term one starts moving up at the same time. That means the trend is powerful, the explosion. So the shorter term rates of change, the medium term, the 7-year I just put, and I'll put the 10-year, when they're all aligned and moving together, then something big's happening. And the 10-year rate of change has just started turning up here a few quarters ago. It's in 2022. So now what you got is rates of change across the spectrum, 4-year, 7-year, 10-year. They're in a new powerful trend. So that thing's going to go up, go up, go up. And eventually they're going to converge, top out, and then start turning back down. So right now, if you want to identify the trend, then you know the rate of change for federal government interest payments is going up. All right? You could even see here, it went sideways for periods, resistance, breakout, support, then another level right here. Sometimes you don't need the rate of change. Somebody could just look at the chart and they could see that the rate of change is exploding. See price action staying above, and then it's just starting to move up. And that's what you've been seeing here, guys. So while the price, even here, see how it kept going up here, the rate of change was going down. It wasn't going up as fast as it did previously in the 70s right here. And even here in the 50s, 60s, going flat, and then after that really started going up together in the 70s, and they went up. All right. So let's move on. When I look at a chart and I see that, I always go to my back catalog in my head of all the charts I've seen. And I know these charts, everything's financialized. And while it might not be apparent in your head, the narrative of why federal government interest payments looks like another chart, in hindsight, you might be able to deduce of the charts. That's why we always call it chart-defined macroeconomics. So instead of having a narrative, an idea, and try to force feed it on the chart, just look at the chart. And after that, if you overlay other charts, then you could start creating a narrative around that. But again, the chart is key. No matter what narrative you think it is, in hindsight, 5 years later, you might realize the narrative was wrong, but the chart is never wrong. So here I have the producer price index. The producer price index pretty much tracks interest payments. Look at that. This is since 1947. Interest payments go up goes the producer price index. And producer price index is the input cost for producers, people who create the goods that you consume. There's a lot of component of oil in there. There's a whole bunch of commodities that go into the production of goods, and you see that through the producer price index, the great proxy for inflation. Look at that. Go sideways, up, sideways. Federal government interest payments go sideways, and look at that. Look, producer price breaks out. Federal government interest payments break out. Now, interest payments going up could be a combination of things, right? It could be more debt. It could be increasing Fed fund rates, right? It could be a combination of both to make that thing go up. But what we do know, no matter what the combination is, more interest payments by the government is creating, or tracked by, or the producer price index is creating that destruction of purchasing power, the increase in commodity prices, right? Because it's not the commodities that are actually going up. The global amount of commodities are going up because the fiat is getting destroyed. I could even add one right here. I'll put purchasing power. So this is purchasing power index for the US new price scale. And this one, this one here. And you see it's inverse to the PPI practically. So I put log, I'll flip it, reset the chart, and look at that. Look how it tracks that also. So here is the purchasing power tracking producer price index, and now it should make sense to you, right? The more the destruction in your purchasing power, so each dollar is not able to buy you more, those commodities will cost you more and more, right? It's just driving all that upwards. While it goes bottom left to top right, what's important, and it's the change in momentums and what happens. Right here, rate of change. I could have put the rate of change for the PPI. I could have put the rate of change for the purchasing power. It would have looked exactly like this, right? Now, we know in the 70s. Well, I'll show you one more chart, guys, before the final one. I want to show you how this fits with Fed fund rates, 10-year yields. I could have put 10-year yields, 30-year yields. Here is the Fed fund rate. I took it because the data goes all the way to 1954. The 10-year yield, it stops in the late 60s, I think, and late 70s, I think, for the 30-year yields. But it doesn't quite matter. Look at the trend in yields. So the Fed fund rate, as the ascent is going up for the rate of change for interest payments, for producer price index, and inversely your destruction of purchasing power. Go hand in hand. Up cycle, rates peak, the rates of change start flattening, down it goes here. Here in the 2000s, little peak in rates, start flatline a little bit, that rate of change goes down, little peak, flatline in the rate of change, it's trying to go up. And look at that here, spike up in Fed fund rate, and guess what else is spiking at the same time? The rates of change 4-year, 7-year, 10-year of federal interest payments. So it's a new cycle, guys. It's essentially a new cycle. Whether you think wherever we are here, this is breaking out and off it moves. So what's most likely to happen, instead of, while the Fed fund rate could go back to zero, I'll show you this one right here. So while the Fed fund rate, they could do some bonker things and bring it back like this. And then after that goes up even more, just like it did back even here in the late 70s, right? Went up, the Fed fund rates. I'll add another chart, TYX, not TNX. I'll bring them down here. The yields, so right here, I'll minimize all that stuff. I'll remove all my drawings. While the Fed fund rates can go back down, see in the 70s here, here's the 10-year yields right there. While the Fed fund rates went back lower than they were when they started, look at the 10-year yields, higher lows. So they could try to reduce the Fed fund rates, but always look at the 10-year yields, 30-year yields, the forward-looking yields. They're going to tell you primarily where the direction of this is going to be. It's going to be more flat, less volatile, while they can control. See, drop them, raise them, drop them, raise them. You'll see that on the 10-year yield chart. It's a beautiful, beautiful channel, less volatility. So you want to look forward to get some guidance on if you're in an inflationary cycle in yields or deflationary cycle in yields. That'll give you a lot of hindsight. Remove your dependency to always, what's the Fed going to do? What's the Fed going to do? Well, look, the market's going to tell you what the Fed's going to do, right? Those 10-year yields are going to tell you what the Fed's going to do. So that's how it fits. So now you're able to see how the yields fit into this. You see where your purchasing power is heading into. You see the more interest payments. It's not the end of the world, right? We've had interest payments go up in the 70s, 60s, 70s. They went up bonkers in the rate of change. We're not even close to that type of rate of change. Let me put the rate of change back, remove the Fed fund rate. Look at those rate of change. I'll remove producer price index here. We've had insane rates of change for longer periods of time here. Look at here. I'll do this one here, angled, thick. This was my 4-year, which one is that? Here. 10-year rate of change. It was at 58 degree. Look how much it did from 1977. Jesus, look at that, all the way to 1985. Remove that. We've barely got started. There could be 10 years of this stuff at a severe angle of ascent for the 10-year rate of change before it even stops. So while you think it's the end of the world and it can't maintain it, well, as long as they keep destroying your purchasing power, which you see the purchasing power chart was in line with the federal interest payments, commodities are going to cost more, purchasing power is going to go down, and federal payments on taxes could keep going up and up and up without breaking anything, as long as it's reflected with destruction of purchasing power. How does that fit in with silver, guys, or any commodities? And that's what I want to show you right now. Let's tie this up. Where is my... Oh, here. Okay. How does it tie with silver? Well, let me put these things back on. Here's a silver chart. While the rates of change in interest rate payments goes up, so the rate of change breaking out, right? Look at this, the rate of change going upwards in an uptrend. Look what happened to silver. Up, 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 until the rate of change started turning over. That was a massive top. Go all the way down. Look what here with the bottom, when those rates of change bottom here. Bottom for silver. Rates of change aren't able to go down as fast as they did before. Silver goes up, 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 up. Rates of change go sideways, or they even start going up. Rates of change start going up. Here. They go sideways, still down the longer term ones. Silver hibernates. Look at that. Look on the explosion here. The rates of change exploding for interest payments. Look what happened to silver. Exploded off the bottom. It keeps going up, guys. Now there's, it's taking a long time. Well, look, there's resistance. There's sellers. There's buyers. There's technical levels. This is macro stuff, guys. This chart's over like 80 years. So that stuff is going to take a long time to play out. But look at the setup right there for the taking on the quarterly chart for silver. Very close to a breakout. It's got that pressure. I could have overlaid gold, oil, practically all these charts. They'll behave the same. Disinflationary cycle, flatline, inflationary cycle, inflationary cycle. This one's a nice one. What's the performance of interest payments versus the SPX? So, or you could see what's the SPX's performance versus interest payments. And it's this chart right here. And I overlaid a 3-year moving average on top of that. When interest payments are going sideways to down versus SPX, that means the SPX is outperforming. Let me just change that. Just put a continuation breakout. No, or just regular breakout. SPX is outperforming interest payments, so the capital flows are heading more into growth stocks than they are in that payment. I could have done that divided, could have been the producer price index divided by performance versus SPX. It could have been purchasing power, performance versus SPX. They're all financialized. It would have looked, the cycles would have looked exactly the same. And when this breaks out above the 3-year moving average, look at that bull era for silver. When does bull era for silver end? When interest payments aren't able to outperform anymore. You're starting to get some slowdowns. 1, 2, back test, breakdown, game over for silver. Down, 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 down. Oh, the federal tax payments aren't able to keep going down anymore. So there's a wake up here. Wake up line. Still not super duper. Wake up line. Silver refuses to go down. Right there. Silver refuses to go down. Goes up. A little rally. There's just this halt, guys. Just this small halt. This sideways move. This rehydration of destruction of purchasing power of interest payments going up versus SPX was enough to create this huge bull run for silver right here, and gold and oil and all that. Breaks down, what happens? SPX starting to outperform again, once again, this inflation or destruction of purchasing power metrics goes down, 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 down. But look at this, bam, hits a wall, refuses to go down, and reverts upwards. And that chart looks like the 10-year yields. I could even put the look at that. Put the Fed fund right here. Whoops, not that one. Could have put any of these rates of change. Look at that, guys. It's no mystery. That's a 10-year yield. Put the Fed fund. Tracks the 10-year yield. Tracks the Fed fund rate. It's all financialized. It's all the same stuff, guys. You gotta look at the weight of evidence. Right now, it's above the 3-year moving average. It's flat. Is it just a spike? Or as we know, the 10-year yields, look at this. This is a huge, huge, huge pattern. 1, 2, 3, 4. If ever SPX or if ever tax payments, repayments break out versus SPX here, this is a huge game changer, just like we had back in the late 60s. It's massive if this happens. And guess what the silver and gold chart are doing? Gold's already at close to all-time highs. Silver's about to break out of a great pattern right here. It's a paradigm shift, but it has to move up. So it has to challenge this. But the pieces of the puzzle are there. If it fails and goes back down, then more growth, the rate of change for the interest payments is probably going to start going down, etc. But again, interest payments, Fed fund rates going up multiplied by the debt burden. So where is that going? Is that accelerating or is that decelerating? And you'll get a lot of clues at what the underlying waves or tidal or currents that are happening that are pushing the asset classes in one direction or the other. So those big shifts, that's what changes the market that needs to reprice and allocate in different sectors, guys. Hopefully that helps put some clarity into what the bigger picture is happening. And no matter what happens on the smart time frames, these macro capital flows, they are there, guys. All right, that's it. Won't keep it longer. Thanks for watching. Ciao, guys. Please subscribe, like, and hit that notification bell. Thanks, guys.